All right, I think we're ready to get started. Hello, everyone. Welcome to the series Mud Talks. My name is Erin McNabb, Associate Director of Alumni and Parent Relations at Harvey Met College, and a proud member of the class of 2006. We thank you for attending today's event, and we hope you and your family are safe and healthy. This talk is being recorded. We will distribute the link and any other presentation materials afterward. This event covers a broad base of information specifically for young professionals and newer graduates. It will be hard to cover everything within the financial realm in this short time we have together. If we see a lot of the same questions that we can't answer today, we may do more of these events in the future with a more focused topic. Please feel free to type your questions in the Q&A box, and we'll try to get through as many questions as we can after the presentation. Now, to briefly introduce our speakers, Bev Orth, class of 74, is an attorney and actuary with over 30 years of experience working as a retirement plan consultant. And Bruce Barton, class of 86, is a certified financial planner who recently wrote the book, Personal Finance for Tech Professionals. Take it away, guys.
Thanks, Erin. And I'm going to share my screen now so you can see title slide here for the presentation. So, thanks again, Erin. Yeah, I'm Bruce Barton, class of 86. Little bio on me. I worked for about 4 years after graduating from MUD as an engineer. Worked on navigation systems for top secret military aircraft, really top secret. And then pursuing an interest in investments and markets. I went and got a master's degree in finance at the University of Chicago. After that, worked in 3 venture-backed tech startups as a product manager. One of those startups went public, one of them got acquired, one of them actually failed. So I had the full range of experience from that time, my time working in the technology industry. After that, I've been working in personal finance for 17 years as a financial advisor, have the CFP and CFA credential. One MUD story I wanted to mention. So about a month before graduation, my senior year, I started hanging out with the social chair, one of the officers, and helped her hang some signs around campus for a party that was coming up, and then helped her edit a paper. Fast forward now, 29 years I've been married to her, and we have 2 kids that are 23 and 21 and just graduated from college as well. So we've kind of got this early career financial stuff going on in our own household. So that's a little bit about me. Bev, did you want to add a little?
Sure. Well, I graduated in 74. I was a math major at MUD, and I married another 74 math major, Tony. And after Harvey MUD, I went to Harvard Law School, got my JD there, and worked in Beverly Hills as a tax lawyer for several years, and found my dream job in 1984, working in the retirement plan industry. So I was an in-house lawyer, working mainly as a retirement plan consultant for 30 years. And along the way, I got my actuarial credentials after, all those exams. And I am currently retired. I retired a few years ago, and I'm a college student again at Portland State University. So I've come full circle. Tony and I have 2 daughters, ages 27 and 30. And like your kids, these are the, early career. We give them help. I try to give them help. They don't always take my advice. So.
Great, thanks, Bev. So I'm going to share my screen again. Can everybody see the presentation? Okay, great. So Erin introduced Bev and I a couple weeks ago, and we've been collaborating on this little short course. As Erin mentioned, it's a huge topic. It's a vast topic, and we've picked what we think are some of the most important issues to go over, and we'll go over those today. I'm going to mention also that the format of this presentation, it's not a typical PowerPoint with just some skinny bullets. It's actually a slide doc. It's got a lot of text in it. It's not quite a full book, but it's kind of a hybrid between PowerPoint and a book. So hopefully you'll have a takeaway here that you can read later. We won't make you read it all on screen here, but Bev and I will talk about the issues, and then you'll be able to go ahead and read it later and have a more sort of more full understanding. So these are kind of some of the topics we're going to go over. Kind of got it broken up in 4 sections here. Getting ready to go build some wealth, and then talk about earning. We'll talk about saving. We'll talk about actually investing, and several subtopics here. So if you see anything there that you might have a question about, make a note and send a question in the chat, and we'll try to answer some going through. And maybe if we don't get to all those, we'll have a question and answer session at the end. So right away after school and in your early careers, it's a great time to get started saving some money and building some good habits. As we'll show you in a minute, with the power of compounding, you can actually develop some net worth pretty quickly. So we're going to go through sort of a little bit about your human capital, which is your ability to earn money, talking about saving and controlling your living costs, compounding, the incredible power of money to grow exponentially, just like viruses, it grows exponentially. And we'll talk about the different kinds of accounts and just some good fundamental investment process to get you going. So preparing, a couple things here. It's pretty important to stay organized, just like in school, like a lot of areas of life. Finance-related things have deadlines. You got to keep track of when your tax returns due, when the car payments due, when the rent's due. So you got to stay organized. Some people do this by keeping statements online. Other people like to still get paper. It's kind of a flip of the coin for me, which is more reliable. Emails in the spam filter or missing missing stuff in the post office. So I'm not sure which is better at this point. It's important to make sure your addresses are following you, that your accounts are up to date so you're getting current information. So change your postal address, make sure your email is on your accounts, and make sure you're getting information you need. A little bit about banking. Probably everybody's got a bank account. You probably know that bank accounts are insured by the Federal Deposit Insurance Corporation. You may not realize that they're insured for as much as they are, $250,000. So it's pretty safe to keep your money in the bank up to $250,000. And if you get more than that, you can spread it across banks and in different account ownerships. So that's a good place to keep money. Checking accounts, you can have unlimited transactions. Savings accounts are limited to 6 transactions per month due to some archaic banking laws. So be aware of that. Taking money out of a bank account, of course, you can use a debit card. There are automated clearinghouse or ACH transactions, which are essentially electronic transfers. And then, of course, there's the old-fashioned way of writing a check. Checks still come in handy sometimes when you might want to delay a payment. Checks take a little while to get through the banking system. So that can be good to keep in mind. So much banking these days is done online. It's super important just to have a good online interface to your bank. All the banks are pretty safe, so just pick one with a good user interface, good online system that you like to use. It used to be that banks would make mistakes periodically, and you used to have to reconcile your bank account statements. It's pretty much unnecessary anymore. Bank mistakes are very rare. What you do need to do, though, is you still need to look at your statements and make sure that there has not been any identity fraud in your account. Make sure that the transactions that are on your statements you recognize. And particularly, thieves are getting smarter and smarter about tricking us. So, you know, if there's a dollar show up here or there that doesn't look like it belongs, you actually need to pay attention to that too, because that could be a precursor to a larger amount of funds that mysteriously leaves your account. So really pay attention to that. It's important to develop good habits early, and part of what you're going to do today is start doing that and just being aware of some of the things. A lot of times it's hard to know what you don't know, so hopefully we'll cover a few things today that maybe you might learn something that you didn't know. So let's get into kind of the meat of stuff here. The first thing in order to accumulate some net worth, to build some wealth, is your earnings power. Because where does your net worth come from? Ultimately, when you're just getting started, you have your set of skills that you have in your education, and maybe a little bit of work experience. And that represents your future earning power. So you'll be able to earn money in the future based on what you know, your education, your experience, your particular skills. So that's called your human capital. Financial economists would refer to your human capital as your future earnings potential, and financial capital as your sort of saved savings and earnings on those savings over time. So really the whole process of building wealth is converting your human capital, your expected future earnings, into actual money, hard assets that you save and invest. And then you get to keep the growth on those investments too. So this chart showing that your human capital declines over time as you have less years to work and less future income stream. And you're converting that all into financial capital, real estate, investments, stocks and bonds. And of course, the point is to get financial freedom at some point where you are not having to rely on wage income to support yourself, and you can rely on your financial capital, your saved investments. Financial freedom date or retirement. A lot of people like to think about this. It's just, when am I free as opposed to when am I retired? So what can you do about this to increase your human capital? I think that's important to think about. You could hop jobs every now and then to try to get a raise, and that's one way to think about it. But more importantly, think about how you make yourself more valuable to the people that hire you, either employers, or if you're an independent contractor, to your clients. What can you do to become more valuable to them? What can you do to become an expert in your field? Can you become a thought leader? Can you write articles? Can you speak at conferences? You want to become that go-to expert. And in addition, you can learn some interpersonal skills, practice interpersonal skills, and learn some of the intangibles as opposed to the concrete, technical skills that you might use in your job. Very important in modern organizations. I like to recommend take a sales class. We're all salespeople. Everybody's got to get their point across and convince people to do things that they want them to do. That whole area shouldn't be left to people that are naturally gifted like that. The rest of us can learn it too. You take a class in creative thinking. Super important. Couple of things here. Sports stars and entertainers have agents. Well, most of us don't have that, so you got to kind of promote yourself, get out there and build a network, meet with recruiters, stay in touch with former colleagues and classmates, talk to people that might know about opportunities. These are all ways you can increase your human capital, increase your future earnings, which of course will translate over your working career into more assets. Another part of this is maximizing your total compensation. Salary and bonus is fine. If you work in the tech industry, perhaps you'll have a shot at some equity compensations, restricted stock options. But also there are employee retirement plans. Employer retirement plans. There might be employee stock purchase plan at your company. These can be super valuable. Often that employee stock purchase plan will allow you to buy company stock for publicly traded companies at a 15% discount. Is pretty common. Which, if you do the math on that, and you get to buy it at 15% discount, your rate of return will be more like 17.6. So that's good. That's free money. Definitely do that. In your 401k, or if you're in a different organization that might have a 403b retirement plan, a lot of times there's a matching contribution. So definitely contribute enough to get the matching contribution. That's more free money. So these are all ways to maximize your benefits, maximize the amount of money you're earning. Some of these programs are kind of complicated and take some study. They're often frustrating. But you got to slog through, understand these things, and maximize that for yourself. And with that, I'm going to hand it over to Bev, who's going to tell us a bit about taxes.
And I love taxes, being a former tax attorney. Well, we can't get away from taxes. They're kind of all around us. There's a list here on your screen of some of the taxes you'll face over your career. What we want to do with taxes, of course, is reduce them, minimize them as much as possible so we're not paying more than we have to. And we want to do those in legal ways, so we need to find the legal loopholes, and we'll be talking about a few of those today. By minimizing your taxes, that leaves you more money to save and invest and take advantage of the power of compounding. For income tax compliance, you're probably aware that you have to file a tax return every year. If you are a US citizen, you are going to pay income tax to the IRS on your total worldwide income. So you might move to the Netherlands and Antilles, but if you're still a US citizen, you're going to pay tax to the US on all of your income. Most states also have an income tax. So every year you're going to calculate your federal and state income tax and report that to the IRS and your state tax authority. The income, oh, not yet. Go back, Bruce.
All right, I'll go back.
Yeah. Usually the tax returns are due April 15th, but because of the COVID situation, the IRS did extend its deadline to July 15th this year, and most states have also followed suit. So your total gross income is what you start with, everything, and then there are adjustments and deductions that come off of that to get to taxable income. You use the tax rate schedule, and that gets you to your tax owed. And we'll go into a little more detail now on the next page. The U.S. income tax is a progressive tax. It's graduated. Currently, the tax rates for this year range from 10% to 37% of your taxable income. I like to think of this as the layer cake approach. The bottom layer of the cake is your first $9,875 of taxable income. That gets taxed at 10%. Then you go up. Each layer has a little bit higher rate of tax on that layer of the cake. So even if you're in the 37% bracket, that doesn't mean you're paying 37% on all of your taxable income. You got to take advantage of all those lower brackets on the lower layers of your taxable income. There are 7 states that currently don't have an income tax. So if you have a remote job, you might consider moving to one of those states and you won't have to pay any state income tax. California has the distinction of having the highest top income tax bracket at 13.3. So it might be the state you want to avoid if you can. Okay, next slide. Capital gains have a special tax brackets. They have special tax treatment, and a capital gain is a gain or loss that you have on your capital assets. These are your investments, your real estate, not including your house, the primary residence, because it has special tax rules. But any other thing that tends to increase in value over time has a special tax rate under the US tax law. The rates on this schedule currently range from 0 to 20%. This is not a layer cake approach. It is, you look at your total taxable income, find the row that applies to you. So most people will be in the 15% row. They will pay 15% on their capital gains assets that you have sold and held for at least a year at the time you sold. So they're not taxed until you actually sell the asset, but then it becomes a long-term capital gain if it's been 1 year. Most states do not have special tax treatment for capital gains, but there are a few that treat them differently. Okay. So the US tax system is a pay-as-you-go system. It's called withholding at the source. That means as you earn your income, particularly your paycheck, income taxes will be withheld from your paycheck before you even get your pay. So you'll get a pay stub and it will show you, probably electronically, but it will show you what was withheld to pay for your income tax, and then also payroll taxes come out to support Social Security and Medicare and so forth. If you don't have an employer, then you're going to have to make quarterly estimated income tax payments and those payroll tax payments as well. This happens 4 times a year, but it's not exactly quarterly. It's a little off schedule.
And Bev, just for clarification, you said if you don't have an employer, do you also mean if you're self-employed?
If you're self-employed, if you are a independent contractor, if you are, if you work in the gig economy, you've got, you work for Uber or something like that, you are responsible for withholding and reporting your taxes yourself. Now, you want to make sure that you have enough paid in during the year so that you don't have a penalty for underpayment when you get to next spring and you have to file your tax return. You might think it's nice to have that extra money and then pay a big chunk in April next year, but there are underpayment withholding penalties if you do that. So try to avoid that. Some people like to get a big tax refund in April or next spring. But that's also not a good idea, because you are just making an interest-free loan to the government. And why would you want to do that? So the best approach is to target what your total income is going to be, calculate what you're going to owe, and then try to get the withholding to match up as close as possible. And the IRS website shown on the screen there does have helpful calculators for doing that. Okay, next page. So now we're going to turn to saving to build wealth. And first of all, the importance of saving. It's the first time in history that we've got so many people spending so much time after they retire and not having an income and living for a tremendously long time. Many people end up being retired for longer than they actually worked. And that happened to my uncle, who was a police officer. And he actually lived a couple of decades longer than he worked. So, and he retired, he died last year, but he lived into his 90s. And that's pretty common. People are living into their 90s and into their hundreds. And how are you going to support yourself? Let's say you retired at 60 and then you live to 90, or you live to 100 or 105. That's 30 or 45 years that you have to support yourself after you no longer have a paycheck. On top of that, our programs, our safety net programs in the US are not as secure as they used to be. The trust funds that support Social Security and Medicare are running low on funds, and in fact are projected to be out of funds in about 12 to 15 years, unless Congress does something to shore those up. So it's really on you to make sure that you have enough so that you can retire and take care of yourself in those future years. Okay, that's where the power of compounding comes in that Bruce mentioned. Starting early and saving as much as you can along the way, you can take advantage of the power of compounding. In this example, we've got a person setting aside $300 each month and investing it at an 8% annual return. And after 40 years, you can see the brown bar is what the person has set aside, $144,000. The gray bar is the earnings on the $144,000. The total amounts to over $1 million in that 40-year period. So it's really a powerful tool to help you get to where you need to be. And starting early actually helps even more. In this example, it's only $100 a month at the same 8% annual rate of return. But the one person with the brown bars started at age 21, saving $100 a month. The second person in the gray bars waited until 30 and then started. The person that started at 21 has more than twice as much money at age 68 as the person who's waited until age 30. So start early.
And where are you going to find this money to start saving with? Well, one good idea is to build a spending plan, which is a little bit of a euphemism for a budget. And of course, nobody likes to be lectured about how much money they should spend, but it really is important to think about this. And it's not about deprivation. Controlling your costs. It should be more about being intentional with where you spend money and having a purpose for how you're spending money. Everybody enjoys some things more than others. And the things that are really important to you, you should spend on them. But the things that are not important to you, you should spend less on them. It's all about figuring out, understanding for you what are the differences between your needs and wants, and just prioritizing. Everybody has to prioritize. We all have limited resources. You got to prioritize. So make saving a priority, and you can still work in spending on the things that are important to you. But just spend some time thinking about what those are. And everybody can save a little money. Look at your credit card statement. Is there something on there that, some online service you signed up for that you don't use anymore? Call them and cancel it. Or, shop your mobile phone bill. You can always knock a few bucks a month off just by shopping it. Or every couple of years, go shop your car insurance, just see if you can get a lower rate on that. There's always stuff you can do. Take a Saturday morning one day, 1 month, and just go prune back your expenses a little bit. And we can build a spending plan. Might look something like this. Here's the first part, and the second part's on the next page here. But I'll just kind of walk through this quickly. At the top, you have your income. So we've got some salary and bonus income here. That's gross income. Okay, you got the monthly amount, monthly and the annual amount, monthly plan, monthly actual, annual plan, annual actuals. You can track how you're doing versus your plan. You'll probably have some pre-tax payroll deductions from your pay stub. In the 401k plan at work, that money gets subtracted out of your paycheck, and that money is not taxable. That's why it's called pre-tax, so you're only taxed on the money after that. You may have to contribute some to your health insurance at work too. That's also a pre-tax deduction usually. So what you're left with is, your income after those pre-tax deductions. And then as Bev was just saying, you subtract, from a tax perspective, subtract your standard deduction, or maybe you itemize usually with taxable income, and then you have to pay tax on that taxable income. So this person lives in California, is in the 22% marginal tax bracket, that layer of the cake. So $6,515 of federal tax, $2,376 actual state tax. And then there's this thing called payroll tax, which surprises a lot of people when they first start to work. What is this extra tax? Bad enough to pay an income tax. This is what you're paying in to the soon-to-be insolvent Social Security Medicare funds. And this is more of a flat tax in California with a 0.9% state disability insurance. Medicare and Social Security tax are taking about $5,900 out of this person's paycheck. So about $14,000 or $15,000 of taxes, leaving take-home pay of about $46,000. So that's what we've got to figure out how to divide up between spending and saving. I'm going to note also here that this person is taking 10% of their salary and putting it into the 401k plan, and that's great. That's a great place to start. And then hopefully you can increase that by a percent every year. Increase it till it hurts is what we like to say. And hopefully you can get up to 20. If you make a lot more money than this, you have to save a lot more, unfortunately. So this is just a starting place. And here's the back half of a spending plan. If you do this in Excel, you can get it all on one page. But here's expenses, and here's just some categories that kind of can make sense. Categories don't really matter. Categories are useful for helping you track and managing your expenses, but really what matters is the total. So notice that this person is planning to spend $3,636 a month, which would leave them $227 to save, in addition to what's going into the 401k plan. So that's good. This is a great spending plan. Notice we got rent capped at 33% of salary. That's nice as an aspiration. Oftentimes that's difficult to live in a high-cost city. San Francisco Bay Area, where I am, pretty expensive. New York, other markets are expensive to find housing, so oftentimes that doesn't work, but it's something to shoot for. So changing subjects a little quick, real quick, to credit cards. And credit cards can be a way to supplement your spending. That's actually a pretty bad idea. So the way you want to use a credit card is a payment mechanism. So charge stuff on the card, pay it off every month. If you're financing, your expenditures, you're going to run up interest costs. Credit cards are pretty much the most expensive way to finance purchases. So don't do that. But it is good to have credit going and start building a credit history. Pay attention to those due dates on the cards. A lot of times they will close out the billing period, and then your bill is due within 20 days or so. So they have a period of time where you're collecting expenses, and then you got to pay. I usually recommend keeping 2 cards, especially in the age of identity theft. Seems like one of my credit cards is always getting blocked because of some data breach. So keep 1, keep 2 if you've always got one that's working. You don't want to have a lot of accounts these days, again, because of identity theft. Kind of keep your account footprint as small as you can, because it's so easy to steal accounts these days. Just if you have less accounts open, more difficult it is to steal your identity. And cards also, there's, you're probably aware there's cards with different perks. Airline miles was the first one, and now there's points back. You can get infinity cards for just about everything. So those are kind of fun. Shop for those. And credit cards built into your credit score. So every one of us, whether we like it or not, there's 3 companies out there that keep track of whether we're a good credit risk. Experian, Equifax, TransUnion are the big credit reporting companies. They maintain a file on us that says whether we pay our bills on time and are responsible with our debt. If you have a little debt and pay your bills on time, you can build your credit worthiness in the eyes of those folks. And that's reported on your credit score as a FICO score, Fair Isaac Company. Credit scores range from 300 to 850. 700 and over is a really good credit score, and you should be able to borrow to buy a car. 300 to 500, the dealer probably won't talk to you and ask you to pay cash. So that's kind of the range there. The algorithms that the credit reporting companies use are a little opaque. Here you can see kind of in this second to last paragraph how some of the weightings work on some aspects of your credit score. Important to know right now, over on the left-hand side there's a URL for annualcreditreport.com. That is a collaboration between the 3 credit reporting agencies. If you go there, you can get your credit report for free from all 3 credit reporting agencies. If you haven't done that ever, do it. That's good to see what's on your report. Look for errors that you can fix and improve your credit score. Right now, during the coronavirus pandemic, the credit reporting agencies are offering free weekly credit reports. So that's actually kind of cool. I pulled mine down just last week just because it was free, and I just want to see if it still worked, and it still did. It was interesting. Okay, that's it on credit. I think I'm going to hand it back over to Bev now to talk about reducing debt.
Reducing debt is a good thing. So you've got all these credit cards that you've run up debt on, but now you've got to make payments on them. Generally, it's a good idea to pay down your debt before you begin to invest, or at least try to do them both at the same time, because the less you have to pay towards your debt, the more you can save and invest. The general rule of thumb that you'll probably hear most often is to pay off the loans that have the highest interest rate first, then the next highest, and so forth. So that will probably be some of your credit cards or your one credit card, whatever you have. They probably have the highest interest rates, so you'll focus on paying those down and getting those down to 0. You do want to think, though, about tax deductibility. Your student loan interest is tax deductible up to certain income limits, and the income limit for this year for a single person, single taxpayer is $70,000. So you can deduct up to $2,500 above the line. That means you don't have to itemize of your student loan interest if your adjusted gross income is under $70,000, and that phases out up until you get to $85,000 in adjusted gross income. So that's probably not the loan interest that you want to focus on if you've got credit cards, because there will be a higher interest rate, and you want to adjust your deductible interest so that you can compare apples to apples. That means you want to look at the after-tax interest rate rather than the nominal interest rates to decide which debt to pay off first. And speaking of student loans, this is a big problem for the current generation of young people. The student loan debt is getting so large that it's threatening the financial future of many young people, makes them postpone their other plans like buying a house or starting a family. There are some options, though, to help you manage the student loans. If you have several federal student loans, you can consolidate them together into a single loan and pick a new repayment plan. It doesn't lower your interest rate, but you may be able to get a new repayment plan that fits your budget better. You can go to studentaid.gov to check those options out. If you have some of your loans from private lenders, you can refinance both your private and federal loans together into a single loan, and that will probably get you a lower interest rate, so that's worth considering. If you have a certain jobs in the government or nonprofit sectors, you may be able to qualify for the Public Service Loan Forgiveness Program. To do this, you have to have the right kind of employment. You have to apply for an income-based repayment plan. It only applies to the federal student loans, but at the end of paying 10 years of qualifying payments, your balance on these student loans will be forgiven. So that is something to consider if you think you'll be in the public or nonprofit sector for at least 10 years of work. There are a few little nuggets that came through in recent legislation. If you work for a company that will pay some of your student loan debt, that's usually taxable income, but this year through the end of 2020, you won't have to pay federal taxes on up to $5,250 of that benefit. So that is good news. If your parents or grandparents have money in a 529 college savings plan, they can use up to $10,000 from that plan tax-free to make payments on your student loans. So talk to mom and dad, see if they'll help you out. And that's a permanent change. That was part of last year's tax legislation. And finally, for federal loans, federal student loans, payments are automatically suspended through September 30. And that was part of the coronavirus legislation. It's possible that could be extended farther, but at least for now, it's till September 30. If you have private loans, check with your lender to find out if they have deferral options as well. Okay, now insurance doesn't sound like an investment concept, but once you've got assets, you want to protect those assets. So you'll want to have various kinds of insurance that will cover your belongings and your own health so that you don't have to pay out a lot of money if you have things that happen. So first you want to make sure you have some good health insurance. If you are employed, you'll probably be offered an array of different coverages and providers so you can pick what works for you. If you have if you are self-employed or you're an independent contractor, then you can buy your own coverage on your state health insurance exchange. If your state doesn't offer one, then there's the federal exchange that you can use. Next, make sure that you protect your car and your other belongings. If you're a renter, buy renter's insurance. It's very inexpensive, but really helpful in case you have a fire or theft of your rental unit. If you own your own house or residence, make sure you get enough homeowners insurance. It will protect your house and its contents and also protects you from liability. Your employer may offer life insurance and disability insurance. These are common employee benefits, but you probably will need more than what the base coverage is that your employer provides, especially if you have a family. So the typical base coverage that the employer pays for is typically 1 or 2 times your salary. And sometimes it's a lot less than that. Sometimes it's just like a flat $25,000 no matter what your salary is. That could be adequate if you have no dependents, but once you add a family, you're going to need more like 7 to 10 times your annual pre-tax income. Your employer may offer optional coverage that you can take advantage of. You should consider that because it's usually offered at a really good pricing because it's a group policy rather than an individual policy. And usually there won't be any underwriting for health conditions. This is similar for disability insurance. The base plan might cover 40% of your base pay, but then offer you the ability to purchase another 20 or 30% or to cover your bonuses, and that's usually a good buy too. An employee benefit that some employers offer is long-term care insurance, which is cheaper when you buy it early, but you're not going to need those benefits for decades. So that's a long time to pay into something that you're not going to benefit from right away. It's a good idea to wait until you're in your 50s to take advantage of that. And once your net worth gets higher than the limits on your home and auto policies, think about getting an umbrella liability insurance to protect you from lawsuits. And it's not very expensive, so I highly recommend it. Next page. Now we're going to turn to investing to build wealth.
Just a quick question that directly from the previous slide. What drives that 7 to 10 multiplier for the insurance? Like, where did that estimate come from?
I'm not sure where it comes from, but it's sort of commonly thrown around, and I use that myself to make sure I'm on target, especially when the kids were still dependent on us. So I think when you start adding up all the different things that you have to pay for, you know, childcare, you've got to pay for the house and the mortgage, and you've got to pay for college education for your kids. All those things combined, typically you'll find it ends up in that 7 to 10,
Right.
7 to 10 times your pre-tax income.
Got it.
You know, you can do your own analysis. It might be less for some people and more for others, especially if you have a lot of kids, then go to the higher end. Bruce, do you have anything to add?
Well, that's right. You're just replacing the income that would be lost. So if you, I mean, you could go try to figure out what the present value of the future income is, and that would be about the amount of insurance you need to have. That's a more complicated calculation. So the rule of thumb works really well for most people.
Yeah. Okay. So we'll start with choosing the right account types for your investing. And the first thing you'll want to start with is your emergency fund. Once you've paid down those debts, or at least have those under control, then your first priority is to get an emergency fund started. Your goal here is to cover a minimum of 3 to 6 months of your living expenses. So from your budget plan, you can figure out, you know, what you need to live on for 3 to 6 months. And if you have suddenly you're unemployed, like a lot of people are now, or you have an unexpected major expense, like you've got to buy a new car because your old one just died, then you've got something to draw from to tide you over for those 3 to 6 months. Longer, if you can get your emergency fund even bigger. You'll want these very liquid and easy to get to, so a bank account, a money market fund, a taxable brokerage account, those will all work fine. If you are saving up for a car or a home down payment, you also need those funds quickly, because you're not going to, you know, wait till you retire to buy your house, hopefully. So they shouldn't be in a retirement account. You'll want them again in a bank account or a taxable brokerage account. A short-term bond fund will work, or short-term CDs, that will work too. If you're saving for retirement, first of all, you'll want to take advantage of your employer's plan. Typically that will be 401k, but we'll talk about some other versions as well. With this type of plan, you make a pre-tax contribution that reduces your taxable income, so it comes right out of your paycheck before you see it, and the contributions grow in the plan until you take the money out in retirement, at which time it will be taxed as ordinary income. The maximum employee contribution this year is $19,500 if you're under age 50. Now, we had a question come in before the program started about what do you do if you're trying to save for a home and you're trying to save for retirement at the same time. That's a tricky question, a tricky problem to solve. I would recommend that you at least put a little bit into your retirement account every year, because you don't want those 9 years from age 21 to 30 to be zeros like we had in that previous graph. So put a couple, 2 or 3% into the retirement plan, and then maybe another 7 to 8% or more, if you can afford it, into your home down payment savings. So then once you've saved up enough to buy your house, then you can ramp up your retirement plan to 10% or higher. After you've contributed the maximum to the employer plan, the next place you'll want to look at for saving is a Roth IRA. And in this, you will put in after-tax money until you're age 59 and a half or older. The money you've already paid taxes on when you put it in, so when it comes out, when you take your distribution, it will be no tax, and that includes no tax on the investment earnings. The maximum Roth IRA contribution this year is $6,000. Again, that's for people under 50. People over 50 get to contribute a little more.
This is the only good thing that happens to you when you turn 50.
That's right. Well, there are a few good things. That's one of them. So if you have more savings that you want to put aside after you've maxed out both the employer plan and the IRA, then you will continue saving into a taxable brokerage account. Okay. We've talked a little bit about Roth and pre-tax, and it's good to know when to use which kind. You know, should you go all Roth or should you go all pre-tax? Well, in this example, we can see that the first example here, there's no change in your marginal tax rate. The pre-tax goes in with no taxes up front. We're assuming a 15-year period of growth here, and 40% marginal tax rate at the time of the contribution. The reason the Roth contribution is only $3,000 and not $5,000 is because $2,000 of that went to pay the taxes. But then they grow and at the same rate, and then the pre-tax at the end of the 15 years when this person's taking a distribution will pay the same marginal tax rate because we're assuming no change, 40%, so that tax comes off and the net balance, $9,000, is the same for pre-tax and the Roth account. There is no difference. What is different is when the marginal tax rates differ between the time of the contribution and the time of the distribution. So if marginal tax rates go down, we're assuming to 25% in the second example, and this is combined federal and state, that's why the numbers are so high. Then the pre-tax account does better because the taxes were paid when the tax rates were higher and the money comes out when the tax rates are lower, so there's lower overall tax paid in the pre-tax account versus the Roth. If marginal tax rates go up, then the Roth account does better. So how do we know what our marginal tax rates are going to be 15 years from now or 30 years from now or 40 years from now? And we don't. It's a good bet that at least the federal tax rates will probably change, increase in the future, but maybe your own personal marginal tax rate will go down. So we need to do a little bit of both, a little bit of pre-tax and a little bit of Roth. Maybe you do 50-50, maybe you do 2/3 pre-tax, 1/3 Roth, something like that. At the time you take your distribution, you can decide which account you want to draw from. So you don't make that decision now, you wait until you need the money, and then you decide, this year my marginal tax rate is higher, I'll draw from the Roth account. This way my marginal tax rate is lower this year, I'm going to draw from my pre-tax account. But you don't make that decision now, you just make sure you have some of each. Now, there are a lot of different types of employer retirement plans out there, and it all depends on the type of employer you work for. If you are lucky enough to get a defined benefit plan, that means you're probably working in the public sector because that's about the only place left that has active traditional defined benefit pension plans. These are your grandfather's pension plans, the kind that pay you a monthly annuity for your lifetime. These are great. All the risk is on the employer, the employee's guaranteed income for their life and probably for the life of their spouse, the surviving spouse. So if you have one of these benefits, it's very valuable, considered a great employee benefit. Now, most employers don't have these types of plans anymore. So you'd be in a defined contribution plan, and they vary. The type of plan varies depending on the type of employer that you have. Most private sector employers offer a 401k plan. If you work in the public sector, you'll probably see a 457B plan. And if you work in a not-for-profit or in a public educational institution, then you'll probably see a 403B plan. They all work basically the same. They vary a little bit in the rules that apply, but they all let you defer a portion of your salary up to $19,500 this year into the plan. And you'll have a variety of investment vehicles. You might be enrolled automatically, but if you are, you can change your contribution rate at any time. So typically you want to make it higher than what you're automatically enrolled at. Whatever amount you contribute, make sure you're contributing enough to get that full employer matching contribution that Bruce mentioned. Okay, I think we're ready for the next page. All of these types are permitted to offer Roth contributions as an alternative to pre-tax. Not all plans offer Roth, but the vast majority do. And if there's an employer match, it will be the same whether you contribute on a pre-tax basis or a Roth basis. So do both. What if you're self-employed and you don't have an employer plan to contribute to? Well, you can use a Roth IRA or a regular IRA to stash money away every year, but the contributions are limited to $6,000 per year if you're under age 50. So you might think about adding a solo 401k plan or a SEP IRA. These allow much higher annual limits, up to $57,000 per year currently. And if you want to go that route, most banks or financial institutions can help you set those up. I've got health savings accounts listed here, but they're not technically retirement plans. However, they can provide even better tax advantages than a tax qualified retirement plan. If you're in a high deductible health plan, you can set aside some money every year to an optional health savings account. Those funds can be used, and that would be on a pre-tax basis. Those funds can be used to pay for your qualified health expenses during the year, and whatever you don't use during the year rolls over and accumulates year to year. So if you don't use any of the funds in the current year and you just let those accumulate every year until you retire, you can take them out after retirement to pay for qualified medical expenses then. And you end up never paying taxes on the contributions or the investment gains. So it's better than either a pre-tax account or a Roth account. And it follows you wherever you go. You don't, when you change employers, that money, you can take that with you. So it can be your most valuable retirement asset. Now, let's say you have, you've been working 5 or 10 years now, and you've got, you've changed jobs, 2, 3, 4 times maybe. What do you do with all that money that's sitting in your old employer retirement accounts? Well, you do have a number of options. It's a good idea to try to keep those all in one place. That makes it easier to manage and keep track of your investments. The first way to handle those is to do a rollover to an individual retirement account, an IRA. If you had pre-tax money, it will roll into a pre-tax IRA. If you had Roth money, it will go into a Roth IRA, so this character stays the same. If your new employer allows it, you might be able to roll over the old money into your new employer's retirement plan. Most employers will allow that, and that could be a good option, especially if your new employer's plan has some good investment choices with low costs. If your old employer had better options, then you might consider leaving the money with your former employer's retirement plan. It does mean that it won't be all consolidated, but you might be better off because the investment options are better or the costs are lower. Just make sure that former employer knows where you are so that you get your statements and you continue to have access to making investment changes. Finally, this is the least desirable option, that is taking a taxable distribution. I know when it can be tempting when you're changing jobs and you've got, oh, there's only $8,000 in that account. I really need it to help pay for my move because I had to move for my job, for my new job. Well, don't do it because it's taxable and you're going to trigger a early distribution penalty because you're under 59 and a half. And that's $8,000 that isn't going to grow with the compounding to, $80,000. So just don't do it. Okay. I think we're on to Bruce now.
All right, good. So yeah, we'll cover some a little bit on investments here. We're going to go through a sort of an approach that a lot of institutional investors would use, which also works for a lot of individuals. So this is a tried and true, pretty vanilla approach to doing investments. You may know some of this already, but let's just go over it and make sure. Some definitional stuff first. You've heard about stocks and bonds. Stocks are a fractional ownership of a company. When you own stock, you have a claim on the future cash flows. So you're going to get dividends essentially in the future. You have the right to receive those. That's why stock is valuable. A bond, that's like a loan to a company. It's like a bank loan, except it's a bond. They're going to sell you a bond. You're going to give them money. That's how they borrow from public investors. It's through a corporate bond, or governments do it as well. You can buy stocks and bonds individually, or you can buy them packaged in a mutual fund format or exchange traded fund, where just several different stocks and bonds are put together and sold to you as a package. That can make it easier to invest. More definitional stuff. So stocks, bonds, cash, those are kind of the three top level categories of investments. When investment people talk about these investment categories, they'll talk about asset classes. Other examples would be large stocks versus small stocks, emerging market stocks versus international stocks in developed countries, corporate bonds versus government bonds. These are all sort of subcategories of stocks and bonds. And each of them behaves a little differently in different economic conditions. So we tend to build investment portfolios around them and think about them as sort of separate pieces of an investment portfolio. Other foundational concepts, you'll hear investment people talk about the returns that were earned by investments, and that's really a shorthand for rate of return. How much money did you earn on your investment? Your rate of return, or your return, is defined as the sum of interest income, dividend income, how much the stock or bond that investment has appreciated before you sell it, and then also how much did it appreciate when you sold it, how much gain did you have in the investment that you sell. So all four of those together make up your total return. And usually we're trying to maximize the total return when we're investing. Another key concept is risk. Risk is generally, what we mean there is the fluctuation in the price of an investment, the price over time. So it's risk, it's called volatility. We've all experienced a lot of that over the last 2 months. We've seen some very extreme volatility. Finance people measure that with standard deviation and a lot of other more complicated ones, but as a first rule, that's standard deviation. It's really important to understand this relationship between risk and return, sort of a fundamental law in finances. To earn a higher rate of return, you have to take more risk. And that can cause trade-offs in portfolio design. But it's kind of hard to understand that. So here's a picture of just a visual representation of risk and return. So what I'm showing here is 4 different asset classes plus inflation, kind of the most basic ones. We've got small stocks in yellow, large stocks in kind of reddish brown, government bonds in gray, and treasury bills. These are 1-month T-bills, which are investments that you can buy. They're loans of the U.S. government. The U.S. government is borrowing money over 30 days. That's a U.S. treasury bill. Generally considered the safest investment in the entire world. So a couple observations here. Notice small stocks, they earned about 11% per year. This was as of March 31st, so after the big dip. At the end of the year, it was more like 12 at the end of 2019. But so 11 or 12% per year, small stocks have earned on an annual basis for going on 100 years now, for 94 years. So we're pretty sure that's what small stocks can earn. Large stocks, this is measuring the S&P 500, the largest 500 companies in the US, about 10% a year. So when I think about investing, I kind of think small stocks 12, big stocks 10. Government bonds, 5 or 6%. Treasury bills barely keeping up inflation. Now notice also small stocks. What do you notice about that line? Super squiggly. That's the volatility. So in order to get that higher return, you got to put up with more squiggliness. And that can be uncomfortable, particularly in times like the last 2 months. But you'll notice there have been other big squiggly times in the past. It's just part of investing. Just get used to it. It's a bumpy ride. Try to build portfolios that can make you feel as comfortable as possible, but ultimately it is a bumpy ride and you have to endure the volatility to earn the return. That's just the trade-off. That's how it works. You could invest in treasury bills and you have a very safe, smooth ride. Look at that. The green line's perfectly smooth, but you barely keep up inflation. You didn't earn anything. So that isn't going to work for most people, especially people living 40 years in retirement who need to have their investments earned. So it's just not going to work. You're going to have to put up with some volatility and take some risk. So what we do is we combine these asset classes in probably the most overused jargon word in all of investments, is asset allocation. And just to simplify this is a recipe. Since I've been locked in my house, I've been making some bread. So this is like a recipe for bread. Get some flour and some salt, put in a little yeast, and that's your bread recipe. So same building portfolio, you put in little stocks, little bonds, little large stocks, little small stocks, or a little real estate, international, and that's your recipe. It turns out that there is a preferred way of combining asset classes. This work won the Nobel Prize. It's pretty foundational in personal finance and institutional finance as well. But there's this idea of optimal portfolio. So the brown line is an optimal combination of asset classes. If you're below the brown line, then there is a portfolio you could build that would either increase your return for the same level of risk, or alternatively, if you selected a return, you can reduce the risk of your portfolio to earn that same return. So part of what investment professionals do is build these optimal portfolios. There's software and complicated math to make sure you're building optimal portfolios. One thing you don't want to do is build a suboptimal portfolio and have that in your portfolio, because then, of course, you're not earning as much as you could for that level of risk. Here's a couple examples of what these asset allocations look like. And the sort of shorthand here is, notice the 50-50 column. That is signifying a portfolio that's 50% stock and 50% bonds. And you can see that down at the bottom, corporate bonds and government bonds total 25% each, so they total 50. Going across the page from left to right, you're increasing the risk. So the 50-50 portfolio is safer because it's got more of the safe, less volatile bonds. On the right-hand side, you've got a portfolio that's 100% stock, no bonds. You can see corporate bonds, government bonds, 0. So this says all stocks. So that's a much riskier portfolio, much bumpier ride, but you'll earn a higher return if you wait long enough. Also notice these portfolios kind of have a good amount of small stocks in them to earn more. There's infinite combinations of different asset classes. This one just kind of has a little bit extra small stocks to get a little extra juice in it. You wouldn't have to do that. You could put a smaller one, but you do have to re-optimize every time you change an asset class to make sure you still got that optimal mix. Those portfolios, kind of historical performance, how they looked, something like this. And notice our risk and return rule still applies over this long period of time, from January 1st, 1988 to 2 different time periods, December 31st, 2019, and then as of April 30th, 2020. So after the little blip we're having here. Notice the rates of return, annualized rates of return over that long period of time, are drastically affected by what happened the last couple of months. So I'm showing you that. But notice the 100% stock portfolio, we knew that was riskier. So what do we know? We know it was going to earn higher return, and it did. And during the downturns, it also drops the most. If you know that going in, you'll be more comfortable sitting tight in your investments and not panicking and doing what some people did back in that 2007 and 2008, the Great Recession downturn. A lot of people panicked on or about March 9th at the bottom of 2009, went to cash, and then missed several years of the upside and really hurt themselves. So don't do that. particularly if you're young and have a long time before you're going to pull this money out of your IRA or your employer's 401k plan. You can't take it out till you're 59 and a half years old anyway. So you just sit tight and just stay invested, and it'll be fine. Here's a couple other resources on asset allocations. A lot of brokerage firms, investment firms have, optimized asset allocations out on the internet. You can find them. There's a couple of books. These are really good. David Swenson ran the Yale Endowment. He got pretty, gained a lot of notoriety in the institutional investment world for what he was doing with alternative investments. And then he went and wrote a book for personal, private investors, individuals. And I thought it was really good. I really enjoyed it. And so I recommend that one. And two of the classics on asset allocation by Bernstein and Gibson are here too as well. Those are, a few years old now, but they're still relevant. The math here hasn't changed. So those are still relevant resources. Now, the question you're going to ask is, well, which allocation should I pick? And a lot of times financial planners will figure this out by doing a financial plan for you, but over working on this problem for years, I've noticed patterns, right? And so here's some heuristic for figuring out what might make sense. So by life stage, let's say you're just starting out, you're in your 20s and 30s, job's pretty secure, long time horizon. You can take some risk. You might be in the 100% stock, 90% stock portfolio. You want maximum growth. Maybe have a little bonds in there just to dampen the volatility a little bit, but you're pretty much shooting for growth. You can't touch the money. Let it rip, pedal to the metal, let it go. Next category, sort of midlife accumulating. You're in your peak earning years, your 40s and 50s. Your net worth's growing, things are looking good. You still have a long time horizon, but maybe dial it back a little. 80-20, 70-30 is probably good. You don't have that much working time left, so if we have a big correction, you don't have that much time to recover. So it's worth maybe taking a few chips off the table, reducing a little bit. Nearing retirement, this one's the big question mark. If you've done a good job saving and investing and your net worth is substantial and you can support yourself in retirement, then maybe you can reduce your risk even more. But if you're behind on your net worth and your saving, you're going to have to keep your portfolio working. You're going to have to expose yourself to more risk than may be comfortable because you still need your money to work. So that's kind of a question mark period of time there. The other one that's interesting is this last period. After you retire, as Bev was mentioning, you might be 40 years after you retire before till your end of your life. So you got to work. Your money has to work a long time when you're not working. It's a very difficult investment problem. So you're probably going to have more stock, more equity in your portfolio than is entirely comfortable, unless you've done a really, really good job saving. So this is a little different. In the old days, you used to retire at 65 and then you dropped dead at 68. So your money didn't have to work for 3 years, but for about 3 years. So you could cut back and go to all bonds, but that isn't the case anymore. So this is something to keep in mind. We're going to go implement that asset allocation. A lot of institutions will, pension funds, university endowments will use index funds, which are just a basket of stocks and bonds, not actively managed, passively managed. They have the advantage of earn that rate of return that you're supposed to get for that asset class, and have really low expense ratios and really low tax costs. So here's a couple of the well-known index fund families: Vanguard and iShares. Vanguard also has ETFs. So pretty much all of these, I think, are available in ETF format as well, which are very tax-efficient form to hold investments. So implement with index funds. I'm kind of rushing here to make sure we finish only a little bit over. One last thing, rebalancing. You're going to have to do some maintenance on your portfolio. Let's say you started with that 50-50 mix, 50% stock, 50% bonds. You can see that here in 1999. Over time, stocks tend to grow and bonds tend to not, because bonds they don't grow. They throw off interest, but they don't necessarily appreciate. But stocks do. So in 2019, this 50-50 portfolio, if you just didn't touch it for 20 years, your stocks would be up at 66% of the value of the portfolio, and bonds down to 34%. So what you should do, and this was calculated as of December 31st, 2019, what if they're really smart to do is rebalance right then and sell some of the stocks and buy some bonds and restore yourself to the 50-50 mix. So we're sort of restoring the risk level of the portfolio. If you let it sit like this in 2019, you had more of the risky stocks and you got clobbered in the downturn. So you're going to do this usually once a year, maybe twice a year is recommended. Rebalance your portfolio, sell some of the high stuff, buy some of the low stuff. And it forces you to do what you've always heard, buy low and sell high. Rebalancing is a sort of a automatic way of doing that. If you just do that, you'll keep your portfolio safe and keep it in tune, basically. This is maintenance on portfolios. So, the approach is develop an asset allocation, pick one that suits your stage of life, implement with low-cost index funds as a first order. If you learn more about investments, there's other ways, but that's a good first thing to do. And then make sure you're rebalancing once or twice a year. All right, so that's it on investments. I think we will take some questions now.
I'll start with some of the more general questions, and then we can get more specific as we go. But I think people beforehand wanted to know how to find like a trustworthy financial planner, when we should implement, like when should we go to a financial planner, and when does professional help really boost our possibilities.
Yeah, okay. I made another slide today thinking about this question. So here's a list of basically go find an advisor website. So my professional organization, the fee-only financial advisors, they're all fiduciaries, all certified financial planners, really highly regarded group of folks. They run and I was on the board of this organization for several years. National Association of Personal Financial Advisors, NAPFA, they've got a Find an Advisor search bar there, search tool, and that's a pretty good one. XY Planning Network, that's another group of fee-only planners, fiduciaries that have CFP credentials. They're kind of targeted at younger folks, so that might be more appropriate for people that are just getting going. Fee-only Network's another search for fiduciary advisors. Garrett Planning Network's another one. Certified Financial Planning Standards Board, that's the standards body that oversees the CFP designation. They also have a search. That one's good as well. If you've got stock option problems, this was on one of the other slides, but the My Stock Option website also has an advisor referral service. So if you've got equity compensation issues, that's a good way to find people that work in that area as well. They're not necessarily all fiduciary advisors or CFPs, but they have that particular expertise that you might be looking for, so you can kind of cross-reference the lists here.
I might add, in my own personal situation, I didn't have a financial advisor until I just got tired of doing it myself. You're busy with your career, you're busy with your children, and you just don't have time to keep track of everything. So that's when I hired somebody, and I'm still there. Even though I'm retired, I'm still letting him take care of the stuff because that's not something I want to spend my time on. I want to do other things. So that's my situation. It doesn't work for everyone, but it's one reason to go that route.
Great. And is there a common financial mistake you've seen with like recent grads and young professionals that they make early in their career that you would suggest they don't do?
Not saving is probably the most common. I know I have to keep pushing my own daughters to keep to keep focused on setting aside money, and they keep saying, "Oh, there's not going to be a world next year." They think everything's going down the tubes, and so what's the point? And you've got to keep them focused on, yes, there will be a future. There will, you will retire someday, and you're going to need those funds.
And then we had general questions about investing in the current climate. You talked a little bit about that. Is there anything more in detail about right now that you want to talk about?
Good time to buy stocks on sale. So if you've got money sitting in cash, start investing in maybe a little bit this month, a little bit next month. Use dollar cost averaging, which tends to lower your average cost. But yeah, that's what I would do. Bruce?
Absolutely, that's what we've been recommending as well. Another thing that's been going on with the market down sharply, a lot of times in your taxable accounts, you'll have paper losses on investments. You can do a trick called tax loss harvesting. Go sell those things, buy back something that's similar, but not too similar, wait 30 days to avoid the loss sale, or the wash sale rule, and then swap back. And that way you can realize some tax losses now, but still remain invested, and that can save you a little money on your tax return this year. So if you're looking for something to Google, go Google tax loss harvesting. But other than that, I would say, just stay invested. If you've got a long time horizon, especially in qualified accounts and retirement accounts, you can't touch the money anyway, just stay invested. At some point here, you'll probably need to rebalance. Maybe wait till we get to the bottom, wherever that is, and then rebalance there.
Sure. Kind of directly following that one, a question just came in. Is there a particular asset class right now to favor or avoid, or? I don't pick asset classes. Build diversified portfolios, pick the weightings, stick with the weightings. Sort of the idea of timing which asset classes are going to go do well over the next period of time. A lot of research has gone into that area. There's not a lot of evidence that professional investment managers are able to actively time which asset classes to be in and which ones to be out of, especially on a cost-adjusted basis. So, if you're just getting started, just do the static allocation, just build it and stick with it. If you learn a lot about investments and become an expert, maybe try it, but I'll tell you, most people that do this for a living can't do it very well. Great.
One thing that's not good to buy right now is a single premium annuity, because the interest rates are so low. It's you're not going to get a good value there. So wait till the interest rates go up.
All right, so more specifically, when you talked about spending 33% of your income on your rent, pretty early on, were you talking about gross income, adjusted gross income, or post-tax income?
Question. Any of the above.
No, it doesn't matter.
Any of the above. Yeah, I mean, if it's hard to find housing in your area, pick the gross. If it's not hard, pick the net.
Got it. And then someone's asking, what happens if you lose track of your 401k and then your employer?
Whoa. Well, eventually that money might be sourced through the Department of Labor. When you file the annual return for the qualified plan, the Form 5500, that the employer has to file, has on there a list of all the participants that are no longer working for the company and the amounts that are in their account. And so you might get a letter from the Social Security Administration ultimately that says, you've got money in this old account here. Here's the information where you can reach the plan administrator, but you might not get that letter until you apply for Social Security. So it might be, when you turn 67 that you get this letter, but it's not lost. It's there somewhere. If you have any old contact information, use that, Google them. There are resources, but it's best not to lose track of it. So that's another good reason for keeping your funds in an IRA after you've left a previous employer. Bruce, do you have any ideas on how to?
Yeah, I mean, call your old employer. You probably know who you used to work for, and even if they got acquired, there's some successor employer that's in charge of the 401k plan, and they can point you to they call it the plan record keeper, the people that actually have your assets, and you can get a new login and get it turned back on, get yourself electronic access to it again.
Great. Someone asked, how would you recommend planning for a retirement before you can withdraw from an IRA without incurring a penalty?
So somebody who wants to retire before 59 and a half, basically. Yeah, well, that's a good reason for having some funds in a taxable brokerage account, because that's money that you can live on until you can safely take money from the tax qualified plans and accounts. And if not, I don't know that there's another good way to access that money. You might just have to bite the bullet and pay some tax, but try to accumulate some funds outside of the tax qualified accounts.
There is one special provision. There's, Bev, I'm sure you know this.
Oh yeah, you can.
Steps.
Yeah, you can take
substantially equal periodic payments.
Right.
Set up a plan where you can take money out before 59.5, but you have to abide by this very strict rule about how much you take out. And
that can blow up. That can blow up too if suddenly there's a big change in the value of your account. Either it goes way up or way down, because then you might be forced to take out way more than you planned to because you were, or less than you planned to. So it's very tricky. I wouldn't try to do that for more than a few years. So if you're at 55, maybe you want to try that to bridge you to 59.5. But yeah, it's just good to have some funds that aren't in a tax qualified plan for that contingency. And if you're planning to retire that early, then make sure you've got money outside of your tax qualified plans just so you can do that.
Got it. Someone asked a very, very simple kind of overarching, how does one actually go about doing any of this investing? Just like, is it through your bank? Is it, do you just create a Schwab account or something? Or?
Yeah. Well, once you've exhausted your employer plans, you can go to the bank. So if you have Bank of America, they'd be happy to set up investment accounts for you. Charles Schwab is an option. Fidelity is an option. You could just Google, investment accounts and see what companies come up. I like to meet with my people, so I want them local, but some people will be fine dealing remotely. Bruce, your thoughts?
Yeah, that's right. There's and even some of the mutual fund companies, Vanguard, you can open a brokerage account at Vanguard and buy their ETFs and mutual funds directly, or you can open a Charles Schwab or Fidelity account, one of the discount brokers, and buy anything in those accounts. And there are some, they call them robo-advisors now, online investing services that you can use as well. It's easy to Google those and find out what some of those are as well. You got to pay them for doing it. So.
Yeah, E-Trade is online, and so there are many, many options.
And what would be an example of a suboptimal portfolio asset allocation?
Well, a suboptimal, and you won't be able to see it. There's no way to identify it unless you go through the math. But it'll have, maybe in that example I showed, it would have, 40% real estate. That might just be too much. It might be too much real estate to make that optimal. You would have been better off having less real estate and more small stocks in that case, that get the same level of risk and earn more return. So it's really just a different set of those portions, those allocations, those percentages in each of those portfolios. It just didn't work to meet the optimization criteria.
There's a lot of questions. Let's go with.
Good. Questions are good.
Give us just the easy ones, please.
I know. Yeah, I've got to figure out the easy ones. So, someone asked if we have the ability to pay off their student loans quickly. Should we? Suppose we can within about 2 years of graduation. And suppose they have a mix of federal and private with fixed rates around 5%.
I would say if you can do it, sure. The tax deduction is limited anyway, so don't just go on the tax deduction. If you don't have any other debts to pay off, then yeah, load it up on the student loan and pay it off. I think that'd be great.
Just get rid of it.
Absolutely. Yep.
There's a long one. I've heard previously that low-fee index funds are the most stable and best idea since they are not eating up your money in fees and tend to perform well. However, I've also heard that these tend to be based on oil companies and other non-sustainable industries. Is that true? And if so, does one find good investments that also don't contribute to social issues like catastrophic climate change? Got a little political in there.
Yeah, no, that's okay. That's actually a big area of investing right now, the so-called ESG, environmentally, social, and governance. So there are, whether they're index funds or other types of funds, you can get funds that have this ESG screen on them now. So they'll screen out the sort of the bad companies. You don't want to invest in, guns or oil. You can get mutual funds and index funds, ETFs that screen those things out of your portfolio. So if that's an important goal for you, you can definitely do that. And the interesting thing about that, I don't know, 15 years ago, even 10 years ago, the social screening, the technology just wasn't as good. So they'd screen out the bad companies and would leave you with a large cap growth portfolio. So effectively, it would limit the asset classes that were available to you. But there's been a lot of improvement in that area. So now you can pretty much build a fully diversified portfolio with those, environmental and social and governance screens on them. So that's good news. So you don't have to give up a return. You can go ahead and do that.
Does the current low yield on bonds suggest a need for more heavily stock-weighted portfolios in the future that was common 10 to 20 plus years ago?
Yeah, that's a fair question. It could be. I think a lot of financial economists expect going forward returns to be lower than they were. There's debate about that. So maybe, but let me also say that for younger people, particularly if you're 100% stock portfolio, it doesn't matter. If you're in a 90-10 stock portfolio, it doesn't really matter that much. So much of the return is coming from the equity portion, the stock portion. The bond portion is just providing some ballast and some stability, and mostly growth you're coming from the stock portion. So it's not as true as you might think. The growth is coming from the stock portion, so it's not as important what's going on in the bond portion.
Got it. I do want to note that it is 6:30, so technically the end of our event time. If you guys are okay, we still have more questions, or we can type them up later. Do you guys have a preference?
Give us another question.
Let's keep going.
Yeah, I'm available. Let's keep going.
All right. So if my compensation comes with a certain dollar amount of stock that is sellable, should they sell it?
Depends on the company. If the stock has potential to increase, I would hold on to it.
Yeah, I think it depends on another consideration there is, what percent of that stock is it of your total net worth? If it's 90% of your net worth, maybe you should diversify and sell some of it. If it's 10%, fine, hang on to it. Especially because you're going to know what's going on in the company better than, maybe you do. Maybe you know what's going on in the company more than a stock analyst that's got a sell rating on the company. It's hard to say. So, a lot of it depends on your situation. Should you diversify? What do you expect the stock to do? A question you can ask yourself is, if I didn't own this stock right now, would I take some of my cash and buy it? And what conviction do you have in that? If you go ahead and buy it, great. Or should you have bought? Would you buy a more fully diversified portfolio? Because even if you sell that stock, you're going to buy something else. You're going to buy another investment portfolio, and it's going to keep growing. So you're not actually going to give up the growth. You might give up some if that stock is likely to do really, really well, but you got to trade that off.
All right, this one says, hey, Bev, I believe you mentioned that not all states have income taxes. In those states without income taxes, does the income tend to be lower as a result?
Not necessarily, but they will make it up in other ways. So there will be higher property taxes and higher sales taxes. The tax money has to come from somewhere. They're just not taking it from your income. So it doesn't really affect income levels, although there might be some association, but For example, Washington, just like Oregon, has no income tax, but their income levels tend to be higher than Oregon's, probably because they have more, well, they have more big companies there like Microsoft and Amazon, but yeah, they pay their taxes through the sales tax and property taxes, and they have a higher tax on corporations.
Yeah, I've got an interesting anecdote there. My daughter was living in Nashville, and so I got to go to Tennessee a few times. And I was driving with the Uber driver one day, and he was explaining how they work taxes there. And in Tennessee, in 2021, they'll have no state income tax. They're reducing it quickly. They're like at 1% this year. And he said what they've done, and this state has a state budget surplus. It's like unheard of. They don't have deficit, they have a surplus. But what they do is they have a huge gasoline tax, because Tennessee is a through point for a lot of truck traffic and other people driving. So they have a big gas tax. They get a lot of tax revenue from people stopping in the state to fill up the gas. So they are able to keep a lower income tax and lower property tax. So I thought that was interesting.
It's good to know about Tennessee. Is it a good idea to start investing as a college student?
Sure.
If you have money?
If you've got the money and you can set it aside, that's even better. You can start before age 21. You can start at age 18. There's no limit to how early you can start.
Yeah, I both my kids did it with their summer jobs. Open a Roth account, put in a 100% stock index fund, and just let it grow.
I think the most important thing is to be on top of your mailing address for that one. Because if you're in college, you're going to move a lot and you're not going to be in access to your mailbox sometimes during the year. So,
well, you don't need to get your statements by mail, but make sure they can email them to you, and you stay on top of changing, if your email address, just make sure you update it.
Right. Got a question. Is it ever attractive to set up a defined benefit plan for a solo business?
It can be, yeah. And there are actuaries out there who will help you do the calculations for what you have to contribute each year to the plan to reach the benefit that you're going to pay out at age 65 or 70 or whatever. So yeah, it can be very beneficial if you've got employees of your own, though. So if it's not just solo, if you've got a business that you're the proprietor and you've got employees, then there are rules about you have to cover the employees as well. But if they don't stay with you very long, then you don't have to put a lot of money in for them.
All right. If you have a non-traditional career and are not expecting to make much more than covers your living and work expenses, would you still recommend aggressively investing, considering like freelancers, graduate students, artists, musicians, gig economists, part-time workers?
Well, absolutely, because if you're counting on Social Security to meet your income needs in retirement, God help you. It's not going to be there. So you got to take care of yourself. So start saving something, whatever you can, and start early. Especially if you don't expect to have high income over your career, that just means you have to let time do the work. So you got to start early, get something going, and let it grow. Yeah.
The people who are relying solely on Social Security for their income, they're going to be hurting. As I said, in 15 years, the Social Security Trust Fund will have it won't be there. You'll have to rely on just what can come in from current Social Security taxes, and that's only enough to support about a 75 to 80% of the promised benefit. So, Social Security is not that generous to begin with compared to some countries, and only getting 75 to 80% of that is going to hurt a lot of people.
Great. And I'm gonna just decide this is our last question because I don't want to go too late into the evening. Do you recommend any other alternatives besides stocks and bonds?
Sure. Real estate and alternative investments, hedge funds, private equity, and I'm sure Bruce can add to this list. But yeah, I've been invested in all of these things, and it's, you know, you get more diversification. They're less correlated to stocks and bonds, and that can help your overall portfolio.
Yeah, I think you hit all of them there. The real estate, you know, buying individual properties, or you can hold it as REITs, real estate investment trusts, sort of a stock-like format. But yeah, private equity, hedge funds. Usually, you need a, you know, significant net worth before you can invest in those type of things, those alternatives. So that might be a little down the road for some of the folks earlier in their career, but that definitely are diversifiers. There's even weird things. For a while, I was invested in trust deeds, which is basically people's mortgages on their homes. So I made mortgage loans to a few people. That was another diversifying, and that one had some really good ones. It was earning 9.5%, 10% interest on a couple of loans to people that could not get loans in any other way. Not advising you to do that, but that's just an idea of alternative asset classes that you can get involved in once you know a little bit more about investing.
And then if you want to go safer, you can buy life annuities, variable or fixed annuities. As I said, it's not a good time to buy an annuity that's going to start paying out now, but you can buy a deferred annuity or deferred longevity insurance. Both of those are good things to help you when you get in your later years, like buy an annuity that isn't going to start until age 80. Well, if you don't make it to age 80, you don't get anything. But if you live to 105, you've got 25 years of lifetime income after that age 80, and that might you know, replace the Social Security that isn't going to be there.
Great. Well, I do want to thank our two speakers today for sharing our knowledge and working together, even though you never met each other. I really appreciate that. I want to thank our audience for all the questions and for attending. We'll distribute this recording. And I might type up the extra questions, and you guys can decide if you want to answer them as well, and we can share that. And then we'll share the slides with everybody probably in the middle of next week. So next up in the Mud Talk series is a Mud Talks called The Diaphragm Pacing Approach to Rescue ICU Patients with alum Andy Hoffer, class of 1970. It's about getting COVID-19 patients off of ventilators, which is really interesting. So that's next Wednesday, May 27th. We also want to make sure our alumni in the audience are aware there's 2 upcoming alumni virtual happy hours. One for the East Coast, one for the West Coast, but you can join whichever one works better for your time. And you'll find more information about those on the alumni website. And finally, I want to offer a word of thanks to those who have supported the HMC's Community Emergency Aid Fund. To date, we've raised over $306,000 in gifts and pledges to help provide assistance to members of our community during this time. And you can find more information about all of these items at our online offerings page at the alumni website, alumni.hmc.edu, and clicking online offerings. So thanks again, and have a great day, everyone. Thanks, Bruce and Bev.
Good night. Thanks, everybody.
Bye.